Hey everybody, this is DayTraderRockStar, and this is the second part of a video in a series called Introduction to Stock Charts and Trading for Kids, Students, and anybody starting from the beginning. And this is a trading video. And today's video is going to be based on the channel. And a channel is a pattern. It's a pattern that the stock price will make. And the last video we did, we actually talked about trend lines, and it's important to follow up with channels now because channels are basically incorporate trend lines. They interchange each other. You can't have one without the other, so it's very important to go into channels. Channels for me are just key for trading. I use channels a lot. It's one of my best trading techniques. There's a lot of information to go over here on channels. I'm going to try to show you as much as I can about trading to make channels to make your trading a little bit more easier. So let's just take a look at a basic channel here. Let's have an example from an old webinar here, and this is just a basic chart, and you can see that we have an underlying channel line or a trend line. And then on top also we have a channel line or a trend line. So this kind of gives you an equal distance parallel line, and it's sloping downward. So we call this a falling channel, a downward sloping channel. And the range is important. A channel is really determines the range that you have in a trading, and in this case the futures, but if you had it in a stock like Disney or ExxonMobil or anything like that, any stock could actually channel out. And it kind of gives you an idea of the range inside that channel. So you could actually pinpoint levels to get in and pinpoint levels to get out. So it's important to recognize a channel, and it's not that hard to recognize it. It just takes a little time, starting off with your basic trend line. So once you have that trend line, figuring out how to make a trend line, and we went over that in our previous video, so you could always refer back to that. And I want to talk about that, and it's a little bit more advanced, how to build a channel. Now, it looks like a channel has to have an important, to have a trend on top, a trend on the bottom, equal distance apart, and then from that point on, we'll take it from there. So let's just take a look at a random chart with no lines on it at all. I'm going to go over here to Nike's chart. This is basically something that you could see every day, and this is the chart of Nike. Nike, you're familiar with Nike. They do Nike shoes and clothing, the sports apparel. Very good company. It's trading at $100 a share, $104 a share. I don't want you to pay attention to the lines up here, the lines down here. We're not going to pay attention to that. It's a little more advanced. What we're just going to pay attention to is the chart. And now, right now, from looking at this, you could tell, if I asked you a question, which way is the trend going, you would have to say that the trend is moving higher because, the direction of the price is moving higher. And that could be told by your underlying trend lines. Each time you have a pullback or a pivot area where the market moves from one point to another point, you leave a little, a bend in the market. Here's one. And these are what we call pivots. So when you have a pretty decent move here, and again, here's one up on top. So once you have these pivots lined up, then you could actually connect them. Connect them like, just take your pivot area up, you take your pivots, you draw that trend line right underneath it, and now you have 2 points. So you have 1 point here and 1 point here, and that's your straight line. You only need 2 points to make a trend line, or a straight line, and from that point on, you actually wait for that trade to come down if you want to do that. But that just gives you the directional side of the trade. Now inside this larger upside, move, you have a slight little pullback. And as you can see, whenever you have a pivot, you start a new little channel. So you start to see an underlying trend down here. It's a smaller trend. It's a smaller trend line, but you can still kind of connect these lows to this low, to this low, to this low, to this low. And again, you could probably go out and also take a look at the top part of that range where you have that pivot area over here. That pivot area connects to this little bounce here. And the next thing you know, you have a nice, what we call equal distance channel. And that's what we look. So it's important. You have to have one good trend line on a channel. The other trend line or the other channel line will be placed afterwards to see if you really have a channel or not. But you could look at it and say, well, I definitely see there's a spot. These all line up. I could draw a line down here. Just make up, then you could use your charting tool, maybe make a clone of the line or a parallel trend line and drag it up there and see if it matches up. And if it matches up, you have a pretty decent channel right here. It's a nice little channel, and from a channel we could start to time our trades. Now, on Day Trading Radio, we specialize in a technique called the 1-2-3 pattern. And the 1-2-3 pattern is really a channel identification pattern. It only gives you, it only requires 3 pivot areas to actually set up a channel trade. And what I mean by that, and let's go out and take a look at this. All right, here's an example using the what we call the semiconductor index. It's just an ETF, exchange traded fund that covers the semiconductors, Intel, different type of chips, Micron, Applied Materials. These are chip stocks, and they're all put in a kind of an ETF fund, and you could trade them. But either way, it's just an active stock, and a lot of people trade it. So if you do see a recognizable pattern, which we call a channel setting up, we want to know, how that channel is going to work out. So just giving you an example, I'm playing this backwards a little, and we see we can actually see this stock push back up, and it pulled back down here, and we're just kind of measuring this out as it goes along. And I want to show you how this thing plays out here. We just kind of go along with it, and the next thing you know, we see it just chopping around. And say you come into it about this point, you start to look at it and say, interesting. I got a definite pivot area here. Remember what our pivot is. Our pivot is really defined by whatever short-term trend we have, and a trend is, again, having a trend line on it. So whatever short-term trend we have, if that trend is broken, basically we're moving from up to down or down to up. That's our pivot area. So we see this tight trend broke down, so we push back down. Now this is another pretty tight channel, and you can actually break this down into different time frames. When I say different time frames, right now we're using a daily time frame, which each candle represents the daily chart, and I should actually do a video on this. But lots of times I like to go to the 60-minute chart, and then you could actually start to see that the channels play out. You can see the channels a little bit better sometimes. But let's go back to the daily, not to confuse you. Every channel has a different time frame on it. So we're just looking at the daily. So here's your short-term trend line. We're going to take that off, just an invisible one, just to kind of show you why that pivot is there. So we circle that pivot. Then we come down here. We have this short-term trend line broken to the upside. You can definitely see a pivot area there. So we're going to put a circle here, represents this pivot. Then you can see we move back up here, and we move back right up here. And again, once again, we push back down. So we have 3 pivot areas. We don't really have a channel yet, but we do really have 3 pivot areas. And that's all we really need, because we just need 2 points on one side. 2 points makes a straight line. How do you make a channel? Well, you take a straight line and you put a parallel line. You drop that parallel line to that pivot area. Now, it doesn't matter, because a channel is going to be equal distance. So you don't really need anything other than one straight line on the top, because that bottom line is going to be just a clone of that. It's going to be a parallel line. So all you need to do is drop it on that pivot area and let it extend. And then as you let that extend there, what happens is the price will come down. And if the price comes down and starts to meet that, let me see if we can actually move this over a little. And we come down to that level, you can start to see maybe a reaction off of this. Now, this is not set in stone. Sometimes it will break down. Sometimes you go through it a little. But the majority of the time is when you have a quality name like an Intel or a Disney and stuff, and you start to recognize these patterns, you'll see a pattern continue to play out. That's why it's important to. So you see actually what happened here is we pulled back to that trend line. We didn't place this trend line there. It was placed already before. So that's what's important. Identify that 1, 2, 3 area, draw that parallel trend line, and then you're waiting for that trade. Now, there's other indicators here that help me take those trades, and I'll go over those in a more advanced video. But the basics here of that moving average underneath us, which we went over the last video, the moving average combined with that 1, 2, 3 channel, that underlying trend line, it combines these two indicators and it makes it a very interesting level to go into. And you can see the market reacted pretty good off of that level and bounced up. And that was a nice bounce. That was probably about 3 points, if not right around 3-point move. And that's a really nice move in a stock. And as you can see, we're just going to go forward. He actually pushed up here, and we kind of started rolling back over. And then we actually came back down to that trend line, and boom, once again, we bounced off of it. So that channel line is actually holding up pretty good, at least on the downside. and then once again we came back to it again, kind of flushed through it a little, and we actually left this really nice candlestick. But the fact is that original 1, 2, 3 pattern and that original trend line held up really good, and that made our area down here a very tradable area. Every time you came down there, you had an opportunity. Now, what I like about trading channels like this is identifying when a channel is going to break out, and there is an exact method I used on doing that. It's called the HPF methodology, and it combines certain indicators. So at this point right now, and for those out there who are familiar with the methodology, this is what we call a lane divergence. And again, this is a more advanced term, so we're not going to go into it, but that's how you could recognize that this level right here is going to represent that channel breakout. So recognizing the channel is important, but recognizing when that channel is going to break out is even better, because that's the mega trade right there. Look at that move. So that was your big move, and that was a lane divergence reversal candle on the lower trend line of a channel. That's what we call an HPS zone. And lots of times a trade will channel back out. Sometimes you might want to put a trend line in. Sometimes it'll never come back, but that's what you're waiting for. You're waiting for the next setup. So once you identify a good channel, you stick to it. You go, you trade it, and then you wait for your next setup. So let's go back over here and take another example of some channels. Now, these are just examples, not the best examples. I mean, it's pretty tight here, but you're just taking a look at this downward channel. Here you have that 1, 2, 3 pattern, 1 pivot, 2 pivot, 3 pivot. Comes back down to 4, goes up to 5, it goes down to 6, and then it breaks out. And there's other things that go on here in a channel. This is what actually called a channel retracement. So whenever you have a channel, that trend line still holds up. Remember, a channel is made of multiple trend lines or channel lines. I interchange them a lot because what you'll see here is the channel is down. This is a very important line here. It tags this level, it tags this level, it tags this level, and some other levels. And when we broke out of it, we actually came back, and it still remains an important trend line. And as you can see, we came back and tested on the upside and bounced off of it. So trend lines and channel lines work great together, and they're important to, even though you might be inside of a channel, once you break out, to pay attention to that channel line again for a retest. Very important levels, and these are the levels you need to be trading. You have to an exact level of interest. You can't just be randomly trying to get into the market. You have to have a reason for it. You have to understand why markets move the way they do, and have the best probability and the best opportunity available to make a little trade. And a trade for me is getting into a stock, holding it maybe 3 to 5 days and getting a pretty decent profit off of it, and then selling it, and then just doing it again, finding the next stock with the same criteria. And the criteria comes up and comes around all the time. I mean, this is a pattern that repeats itself in the market, so it's very easy to trade off of it once you identify it. Here's an example of that upper trend line. We have a little pivot area down here, and we just dragged this line, and this ended up being, this was a live trade. I remember posting this. This was back, wow, this is really back in 2010. And, it's quite and that's why these patterns always continue to work. I mean, it's 2015 now, and this is a chart that I was trading back then off of this 1, 2, 3 pattern. And I'm just showing you this is where we picked it up. In the next chart here, you can see where May was. We bounced up off of that channel line, pulled back, chopped around, but that's basically your 1, 2, 3 channel. Came down 4, you probably came down again 5, and each one of these is a trading opportunity. I mean, 65 to 69 is 4 points in the trade. You're not going to get all 4 points, but you're going to get a probability trade in your direction. There's other signals here you're also going to learn about how to add to that confidence level, but this is a great number 4 right here. So we talk about 1, 2, 3 patterns, and the general rule is to find a 1, 2, 3 pattern, you trade 4, 5, and 6. That's my general rule. So if you have 1, 2, 3, 4, now it doesn't mean it has to be 5 up here. It's just whatever tested it, whatever line gets tested again. If we bounce off of 4, push up, and then come back and bounce off of again, it's still a valid test. So this will be 1, 2, 3, 4, 5, and then, wherever it's going to go from that point on. Here's another example, just a basic example on the 5. This is on a 5-minute chart, so it depends on time frames, and again, we can talk about time frames. I'm going to make it a point to do time frames next video, even though it seems like a simple concept. We have to understand there's all different, like, these patterns play across what we talk about as a 1 minute time frame, a 5 minute time frame, a 15, 60, a daily, weekly, monthly. You'll see these patterns play out over and over again on multiple time frames. So they're giving you the opportunity on a very short time frame, maybe within a 10-minute trade. You get a move from down here, you see a trend line, it pops back up, and the next thing you know, you have a nice trade in a matter of 10 minutes. And you'll see that as we bounced off of that. Now you can see the reactionary trade off of that. And on the futures, it's the same thing. And the futures is another trading vehicle. It's what we call the ES mini futures. And again, we concentrate on these channels all the time on the futures. Every day I look for these channels and we identify them. 1, 2, 3, 4, take the trade. Boom. And it kind of runs into and again, a little more advanced feature here is the timing of the trade, the moving averages, the 20, 50, and 200. We discussed that in the previous video. That would be your exit area. So whenever we have a 1, 2, 3 pattern, just because you have an entry entry level, you always have to have an exit level. What kills traders the most is greed and fear. So this kind of, this helps with the fear because you understand why you're getting into this. You're actually buying into the weakness. There's a good area of support down here. It's a channel line. But the question is, you get that bounce and you end up holding on. It doesn't mean that this can't return back down to this trend line, and that would be actually underneath the previous zone where you got in at, and it would be at a loss. So it's important to every trade that you take and it works, you have to understand why it's working and why you should be getting out. These are short-term time frames. This is on a 1 minute chart, so it's not, this is not the beginning of the next major bull market, just area. It's going to give you a bounce from here and probably a bounce up to the 50, and it's going to come back down. But in that time frame and in that strategy, that's a very successful trade, and that's good. That's what we have to concentrate on. Here we have another, I call this a stochastic plus trend line. We talk about stochastics as an advanced feature, but again, another good channel. 1, 2, 3, 4, little bounce, 5, push back up 6. See, this one actually came down to 7 before breaking out. But again, you're looking at downward channels typically get a bigger move breakout to the upside, and rising channels, which I haven't seen an example of, I have to show you one, has the tendency to break down. Now, channels are channels, but channels are also flags. Flags are a great pattern to trade. You could interchange those names, a flag and a channel. Flag is actually a small channel. In some cases, you get a move up here, and then a small little pullback in a flag, and and then a continuation pattern. So lots of times we'll label these as flags or channels, but they're both pretty much dependent on the size and the shape. Lots of times you get a nice move up, you flag out, you push higher, flag out, you push higher. Just understanding the concept of the channel, it's always better to take the trade on the lower trend line in the bullish trending market. On a pullback, you're having a pullback and a bigger trend. So it makes sense to buy the weakness versus chasing and buying the top and thinking you're going to get a breakout or anything, because most likely you're going to pull back. So, not a bad strategy there. Another interesting fact, and you might read this in books, what we call measured moves. There's a lot of patterns out there, and I only concentrate on maybe 4. The channel, the wedge pattern. We'll call flag as a different pattern altogether, the inverted head and shoulders pattern. But with any of these patterns, what we have are what we call measured moves, targets from this. Now, I use different targets to get out of my trade based off moving averages, based off momentum and stochastics. But a lot of people back in the day, what we used to call measured moves. And a channel would give you a measured move equal distance to the width of the channel. So what that meant is you take your width. If you have an established 1, 2, 3 pattern and it's tested, you take that width, and let's just say it's that wide. I'm not going to measure it out. I'm just going to make a little stick figure there. And what you do is you extend that from the breakout channel, and that typically brings you to where you want to look at your target on that wedge. So as you can see, we actually pretty much went up to that level. Right up here, we popped up to that level. Again, horseshoes and hand grenades, meaning that there's nothing going to be an exact touch. I mean, if you do it, you got lucky on an exact touch, but you're basically getting in an area where you're having an interesting level that you have to pay attention to because of certain, certain indicators aligning themselves. In this case, you have a little measured move that did work out to that point. And I think I missed showing you the measured move. Here's that channel. Sorry about that. Here's that channel. What I did was take that, just the width of the channel, basically, and pull that back down a little, and extend that where the breakout is, and that's usually what we call the measured move, and we usually move up to that level, and that's what we qualify as a measured move. And you can see that this actually did perform perfectly with that, and we pulled back off of it and actually started showing some resistance up at this level. But a great little measured move out of that flag, or out of that channel right there. Now here's a textbook example of an active trade. We just took this trade. I just took this trade last week, and I took it off the rest of it today. A great example of what we call a 1-2-3 pattern. A great pivot area here, a pivot area here, a pivot area here. Now this is kind of weird because that pivot area is not in the middle of these two. A lot of people think they have to have a kind of an organized looking trade, but as long as you break through that downward, if you had a trend line up here and you broke through, you're really counting this as a good pivot area. This is a good pivot area, and this is a good pivot. You have to count all three of these. You draw that channel line in here and you wait for that area. And what I do here at Day Trading Radio is I mark off these levels, identify these channels, identify the patterns, and what we do is we have an HPS site. It's called the high probability site. So these are all high probability setups. And what we'll do is we'll put this in the program. These are all the charts that are setting up on HPS setups. So each one has a different chart, and most of them, again, you're going to see HPS type of setups. You're going to see these 1-2-3 patterns. Here's a great 1-2-3 pattern, as you can see it right here. I even marked this one off. That beautiful pivot here, beautiful pivot here, beautiful pivot here. We waited. You see, remember we talked about flags? Well, here was a great example of that channel flag and that breakdown, a channel flag and a breakdown. But that is a bear flag. It's a different technique altogether, but inside we're talking about this bigger pattern. So I'm really concerned about this. I'm concerned about the underlying dotted line here. So what we do is we have that target here, our target where we're going to get our entry in, buy zone 66.50 to 65. That's all programmed into our dashboard, and when it's hit, you automatically get a text message or email, depending on how you set it up, and it'll alert you. And if I take that trade also, and from that point on, you can actually see this bounced and actually hit our target real fast today. So we bounced right off of that 1-2-3 line, and it just pushed right up against the profit zone right there. And that was it. We got $1.33 onto that. And the same thing, again, we could go right back to the other setups. That's Scripps Network. We talk about Bed Bath & Beyond. Take a look at this one. Let's give it a second to line up here. And again, it's just when I'm really, 1, 2, 3, we came right down to that line. We took the trade, took a big trade in this, and boom, explosive move right off of there. So the channel is, identifying that lower channel line off a 1-2-3 pattern, being able to step in there. You could add the reversal candles, you could add the moving averages, you could add some other things, but this is a basic channel trade, meaning that you're learning how to identify a channel, wait for that channel, that trade or that price to get down to that channel and take that trade, and then hold on for the ride. All right, does this look familiar? Another HPS setup that we took this last couple weeks. Again, the same thing. You have that trend line breakdown. You have a new channel, 1, 2, 3, 1, 2, 3. That top trend line is the one that you're concentrating on. That's the established one. The one down here is you have that main pivot area. You drag that down parallel line, and you're saying, all right, this is where we want to be in. Now, I usually put a buy zone around that because I know that sometimes we get down to it and we might not. So what we do is we alert you that it's getting down to it. It's up to you if you want to look at that. And you can see the reaction off of that. We actually got into that trade, and it just exploded up. So the channels are very powerful, very, very powerful to trade. Love them. Easy to identify if you know the right technique, and there's a lot of other tools that you could use with the channel, using some other different indicators, the moving averages, the stochastic indicator. There's divergences you could use. There's so much to go along with the channels, and that's going to come in a later video. Well, basically, you learned how to identify a channel, how to put one together, what a measured move is out of one. I don't want to get in too much detail. These are going to be basic. The next video I'm going to do is called the falling wedge pattern. Now, I didn't show you any rising channels, but basically let me show you a fast rising channel. All right, here's JB Hunt. This is a trucking stock, and this had a long base, basically a year. It's actually been in a sideways channel until it finally broke out of there and really established a new upside channel. And with that upside channel, you can start to break that down and start to identify the pivot areas: 1 pivot, 2 pivot, 3 pivot. You came back down to 4, you pushed back up to 5, and it's basically the same thing. You have an opportunity to buy on the pullback, which we love to do on an upward trending trade, or actually, a concept of shorting stock on a situation where we get up to a little bit, up to the upper part of the channel line. Combined with this little reversal candle, made it a good short opportunity. But that's, again, a little different technique on shorting. Shorting into strength like this, you want to be very careful on any type of short, especially in the trending and an aggressive move market. We tend to have a great opportunity when you establish a very strong trend. You know that the trend is your friend, and you're able to take advantage of the pullbacks as long as you have an underlying trend line. The tighter channels that come inside the bigger channels are very important. There's a technique I use. It's called X marks the spot. It's where two channel lines converge. So we have this bigger channel, this large channel, but inside that channel we have this small channel that's pulling back, and the lower channel line of that small channel intersects with the rising channel line, and these levels always work out great. So channels within channels, a little more advanced stuff, but here's the upward channel trend line. Again, same concept: 1 pivot, 2 pivot, 3 pivot. Here's your 4. Here's your 5. You can see how it just bounces off of these levels and continues. And these are your optimal trading areas. These are where you want to be looking to trade the market. All right, so that is part 2 of a video series. I hope it was not too technical in nature. I know this. I'm trying to make this a very basic beginner type of video. So we did talk about pivot areas. I don't know if you got that concept pretty good. I don't want you to think about stochastics or any of the other reversal candles. We're going to get into those on other videos. I'll bring those up pretty fast now that I kick this back off. But basically, how to identify a channel and what a channel means, and how to put it together before it actually happens. The 1, 2, 3 pattern, a very good thing, because trading 4 off of 1, 2, 3, 4, 5, and 6 are golden areas. All right. So I hope you enjoyed that. I'm DayTraderRockStar, and this is a video, part 2 video, and look for part 3 coming up soon.